Gold just broke the rules of the financial system. $5,000 an ounce. Not in a decade. Not after a war ends. Right now. And here's the contradiction that should make you uneasy. This didn't happen during chaos on the streets. It happened while leaders kept saying things were under control. In just 12 months, gold surged 84%. Silver didn't follow. It exploded, up more than 250%, tearing past $100 an ounce like gravity stopped working. Markets don't move like this because of inflation headlines. They move like this when confidence snaps, when investors quietly decide the old map no longer matches the terrain. And whether you've ever bought an ounce of gold or not, this matters to you. Because when capital runs this fast, it doesn't just change prices, it changes jobs, currencies, trade, and the stability underneath everyday life. But here's the part nobody wants to say clearly. This move didn't start with metals. Metals are just the smoke. The fire started somewhere else. And once you see what forced the market to panic first, this rally stops looking crazy and starts looking like a warning. What you're watching isn't a random spike. It's part of a larger pattern that's been quietly forming, then suddenly accelerated. The trigger wasn't a single data point. It was a shift in how the world is behaving. Capital is rushing into metal because the assumptions that once protected it are breaking down. The international order that made risk predictable is eroding, and markets can feel it faster than politics admits it. The warning signs weren't subtle. The global system meant to enforce rules is openly described as fragile, even collapsing. The phrase being used is stark, the law of the jungle. That matters because markets are built on contracts, enforcement, and trust that agreements will be honored. When those guarantees weaken, money doesn't debate, it flees. That's why this rally looks panicked instead of orderly. It's a flight to safety so aggressive, it suggests investors no longer believe diplomacy can contain conflict. But here's the reframing question most people aren't asking yet. If gold and silver are moving as if the guardrails are gone, what exactly does the market think is coming next? And more importantly, what does it think won't stop it? Here's the claim that makes this uncomfortable. The market isn't hedging risk anymore, it's front-running instability. And you can see it in the speed. Gold didn't grind higher over years. It jumped into uncharted territory, blowing past $5,000 an ounce, while silver didn't just rally, it went vertical. 250+% in a single year. Nearly $110 an ounce. That kind of move doesn't come from optimism, it comes from urgency. Look at the behavior, not the headlines. Traditional resistance levels didn't slow this down. There was no pause, no digestion. That tells you something critical. Sellers didn't step in because they didn't want to. When a market refuses to sell at record highs, it's signaling fear of what comes after, not excitement about what's happening now. This isn't pricing inflation. It's pricing a recalibration of the system those prices live inside. Now notice what's missing. There's no single crisis being blamed. No one event you can point to and say, that's it. Instead, the move is broad, violent, and synchronized across metals. That's what happens when confidence breaks quietly behind closed doors before the public narrative catches up. And here's where the story flips. If this were just speculation, it would already be unwinding. Instead, it's accelerating, which raises the next question the market is already asking, even if no one says it out loud. What happens when geopolitics stops being background noise and starts dictating prices directly? This is where the temperature jumps, because the instability the market is pricing isn't abstract anymore. It's being spoken out loud, on camera, in plain language. The escalation isn't hidden in policy papers. It's explicit. A sitting US president publicly referenced a massive fleet positioned against Iran, adding almost casually, maybe we won't have to use it. That's not coded diplomacy. That's a direct signal of kinetic force sitting on standby. Markets understand what that implies faster than voters do. A naval armada in the Middle East isn't just a military posture. It's a threat to the energy arteries of the planet. Shipping lanes, oil flows, insurance costs, supply chains. This is how localized tension becomes global price shock. We've seen versions of this before, not with the same platforms or speed, but with the same result. When military language normalizes, markets stop assuming restraint. And notice what's becoming routine. Statements that once would have triggered emergency summits now scroll by as headlines. Threats are made, then shrugged off, then replaced by the next one. That normalization is dangerous, because when escalation becomes background noise, miscalculation becomes inevitable. Here's why that detail changes everything. Markets aren't reacting to war. They're reacting to how casually war is being discussed. And once that threshold is crossed, the logic driving money into metal stops being emotional and starts being mechanical. Now, the evidence gets harder to ignore because the tension isn't staying in one region. It's spreading. While eyes stay fixed on the Middle East, a quieter shock hits from the opposite direction. The United States signals potential military deployment tied to Greenland, paired with the threat of tariffs against countries that resist American control. That's not a symbolic move. That's geography being turned into leverage. Here's the contradiction that should rewire how you see this. Publicly, this is framed as security and trade. But functionally, it's a signal that force and coercion are back on the table as normal tools of policy. Resources, territory, shipping routes. The Arctic isn't a future problem anymore. It's being pulled into the present. And markets are reacting in real time, panic buying metals because algorithms don't know how to price a world where new military fronts open without warning. Now stack that with what happens next. The United States issues an ultimatum to Canada: sign a trade deal with Beijing and face an immediate 100% tariff on all goods entering the US. Not negotiated, not phased, immediate, announced on social media, bypassing diplomatic channels entirely. Here's the line that changes everything. When economic survival can be threatened with a single post, supply chains stop being reliable. And when supply chains stop being reliable, capital stops trusting paper promises. This is where the pressure stacks fast. While gold grabs the headlines, silver starts behaving like something is wrong behind the scenes. It doesn't just rise, it accelerates 225 to 252% in a year. Prices rip past $100 an ounce, pushing toward 110 with almost no resistance. That's not enthusiasm, that's a squeeze. Because silver isn't just a metal. It's a tiny market with very little margin for panic. When money rushes in all at once, there aren't enough sellers to slow it down. Doors close, prices gap higher, and suddenly what looked like a niche move turns systemic. At the same time, inventories tighten, lease rates spike, traders scramble for physical bars instead of paper contracts. That's a quiet signal most people miss. When lease rates jump, it means someone needs metal now, not later. Now watch how fast this spirals. Years of compounding deficits collide with a sudden rush for delivery. There's no buffer left. No's are passed to smooth the shock. This isn't a correction. It's a supply chain heart attack unfolding in real time. And here's the question hanging over everything now. If a market this small can break this violently, what happens if the stress spreads to larger ones? Now shift the lens, because this isn't just a market story anymore. It's a lived one. When metals move like this, the effects don't stay on trading screens. They bleed outward, into prices, into jobs, into decisions you didn't sign up to make. You feel it when energy costs refuse to come down, when goods take longer to arrive, when companies quietly freeze hiring or pass costs forward because they can't trust next quarter's inputs. This is what instability looks like at ground level. Not panic, friction, the kind that shows up as uncertainty in everyday life. Businesses hesitate, consumers pull back, governments talk calmly while acting urgently behind the scenes, and you're left navigating a system that feels less predictable than it did a year ago, even if nothing dramatic has happened to you personally yet. But here's the uncomfortable truth. Markets move first because they're allowed to be honest. They don't wait for press conferences. They react to incentives, pressure, and fear in real time. When gold and silver behave like this, they're reflecting expectations about the world you're about to live in, not the one you're leaving behind. If this feels familiar, say so in the comments, because recognition is often the first signal that something bigger is already underway. Step back from the emotion, because the real insight here isn't outrage, it's mechanics. This keeps happening because the system rewards it. Power now moves faster than oversight. Decisions are made for leverage, not stability. A tariff threat, a military hint, a sanctions move. Each one creates spectacle, and spectacle creates control. Markets aren't confused by this. They're adapting to it. Here's the unsettling part. Institutions haven't disappeared. They've been sidelined. Incentives favor speed over coordination, dominance over restraint. When that happens, uncertainty becomes structural, not temporary. And in that environment, assets that depend on trust, courts, or promises lose relative value. Assets that exist outside the system gain it. That's why this doesn't unwind after a headline fades. The mechanism is self-reinforcing. Fear feeds positioning. Positioning feeds price. Price validates fear. And each loop tightens faster than the last. This isn't about panic buyers being irrational. It's about rational actors adjusting to a world where unpredictability is no longer an exception. Here's the calm but dangerous insight. When instability becomes the incentive, the system doesn't correct itself. It leans into it. And that's when markets stop oscillating and start migrating. Now look forward, because this is where uncertainty turns into trajectory. From here, there are only two broad paths, and neither is clean. In one version, pressure keeps building but never fully breaks. Threats remain threats. Tariffs stay leverage, military language stays just short of action. Markets adapt by permanently repricing risk higher. Gold and silver don't crash. They stabilize at levels that would have seemed impossible just a year ago because the world never quite returns to normal. In the other version, one misstep lands. A trade signature triggers retaliation. A deployment turns kinetic. A sanction crosses a line that can't be walked back. In that scenario, volatility doesn't spike briefly. It resets upward. Liquidity thins. Safe assets don't just rise, they gap. And policy responses come after the damage, not before it. The key point is this. Both paths assume momentum continues. The market has already voted that the old assumptions are gone. Now notice the tension. Everyone is waiting, but no one is positioned for calm, which means the next move doesn't need to be dramatic. It just needs to be real. Here's the insight that ties all of this together. This wasn't a gold story that became geopolitical. It was a geopolitical shift that finally showed up in prices. $5,000 gold isn't a victory lap. It's a receipt, proof that the market has already accepted a more fragile world, even if the language hasn't caught up yet. The real recalibration isn't about metals. It's about trust. Trust in rules, trust in restraint, trust that tomorrow will look enough like today to plan around it. When that trust erodes, money doesn't argue. It moves, and once it moves, it rarely goes back to where it came from. This is why this moment matters. Not because it's dramatic, but because it's quiet, structural, and still unfolding. The next phase won't announce itself cleanly. It will arrive through pressure, normalization, and decisions made under stress. If you want to understand what comes next as this recalibration deepens, stay with this channel. Because this story doesn't end at 5,000. It starts there.